All right, I am back. Welcome, everybody. It's 10 o'clock. We're officially going to get started here. My name is Jim Cagnino with Infinity Futures. And I'd like to personally thank everybody for coming here today. We're going to have a big crowd, big group of people. So feel free as the presentation goes forward to use your question and answer box. And David is very excellent at answering questions on the fly, and I will do my best to do so as well. I do want to remind everybody before we get started here, trading futures, options on futures involves substantial risk, substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility, and although that could be an equation for opportunity, it's also an equation for risk. So be careful, only fund your futures trading account with risk capital. My personal definition: money I could afford to lose, doesn't change my lifestyle or lengthen my retirement horizon or overly anger Mrs. Cagnina. Now, that last part's a little tongue-in-cheek, but stress in life does matter, and it does cause you to make some bad decisions. So be careful. If you're not sure where you fit on the risk capital curve of things, feel free to call in and talk to a professional here at Infinity. We have a whole bunch of customer service reps. It's a no pressure sales shop. I'd be happy to talk to you about risk capital and futures trading in general. Right off the bat, can we get a copy of the slides, and can we get a copy of the recording? There'll be a recording available within a day or so on our YouTube channel, and I'll notify everybody of that. All right, and we have with us David Lerman, Senior Director of Education at the CME Group. David is an expert in futures trading. He's been around, and I'm going to say that with a high degree of confidence. He has been around for decades, maybe a long time, doing this and working specifically with the CME Group, and his knowledge is vast and deep. So feel free to take advantage of that with questions as we go. He has an excellent presentation. I've actually gone through it. It's pretty cool. So what we're going to do is he's going to do his presentation in the first half today, and then I'm going to pop in and show some charts and talk about maybe some trade ideas. In the meantime, though, before we get started, we're going to do the same thing we did last time. I'm going to pull up a gold chart, and we're going to look at three different charts. Here is a daily chart. It's actually a 1,380 minute chart because there's 1,380 minutes in a 23-day period. So it's pretty accurate. And I have this chart starting from 1,700 hours, which is 5 o'clock last night, to 4 o'clock at the close today. So here's the chart. We got a linear regression. We have an ADR at the bottom. I'll talk more about that later. We're gonna look at three charts. This one, we're gonna look at a 15-minute chart, and then we're gonna look at a market profile chart, and we're gonna decide to go long or short at the beginning of this presentation. And this is probably the most important chart people want to see, is the 15-minute chart, and we could see some downward pressure forming here. The next thing we're gonna do, last thing we're gonna look at, is a market profile chart. I have this market profile chart bifurcated between last night, which is right here, price action, point of control around 1294, and today's sessions market profile, point of control around 91. So that's all you get to know right now before you decide long or short. And let's decide long or short. Go ahead and vote. We got some short votes already. Just type in what you think, long or short, and I'm basically going to go ahead and we're going to unwind this trade at the end. So this is an hour trade. This trade is going to be good for 45 minutes to an hour. We got some longs popping in there. Shorts are winning 2-1. Well, now we're kind of evening out a little bit. All right. Yep. I'm saying shorts are a little bit bigger than longs right now. No, we saw the chart once, John. You can't see it again. Or who has said that? You had one quick peek. Wow, we're pretty 50-50. ABL gets to the market profile stuff later. All right, we're definitely going short here. Let me just get this. Let's get this trading ladder. This is the Infinity AT trading ladder here. We're going to do a one lot. We're going to throw a limit order in. We are short right now at 1290.4. 1290.4. I'm going to close this up. I'm not going to close it up. I'm going to move it out of the way. Now I am going to hand the head. Good luck on the squeeze shorts, KC. I'm going to hand the mic over to David, and thank you all for coming. You are live.
All right, hope everybody can hear me. Quick sound check. I assume everything's good, and we're going to roll right in here. Again, thanks to Infinity and James Cagnina and a whole bunch of other folks. We, on behalf of myself and the Merc, want to thank you. This is, I think, the fourth or the fifth in the series of seminars we've done. The first one we did about a month and a half, 2 months ago with crude oil, and Jim made a fantastic trade. We got short crude at 75, and over the last couple of weeks, I've been thinking of him over the holidays as crude has nosedived into the 40s and made it down to like 40, 42 at one point before the most recent rally. So today, though, we're going to talk about metals, and let me get this thing going. All right, so we have a chart here. Let's go back. We're going to talk a little bit about just fundamentals, what drives markets and stuff like that. But I always like to kind of start presentations with long-term charts. And believe it or not, back in 79, between 78, 79, 1980, one of the major, greatest parabolic uprise moves in the financial world was in gold. Gold went from basically about $100 an ounce all the way up to $875 an ounce. It was a gigantic parabolic move, and it never saw that level again for the next 20 years, 20-something years. And you can see on this chart, between 1980 and 2005, we basically churned between $250 and $500 an ounce. And then finally, in like 2006, 2007, we started to break out a little bit. Then we had that major move up to 1900, basically. We've come down. We gave back almost half of it, actually half of it. And again, we've been churning here since 2015, 2016, between 1100 and 1300 for the most part. And of all the moves that we've had in the markets in the last year or two, we had this very, very quiet volatility environment in 2016 and 2017. Nothing really moved a lot. And then early 2018, the U.S. stock market finally did move. And then in late 2018, everything moved. The metals, interest rates, everything started to move. We finally started to have volatility. The only thing that hadn't moved was gold, and that finally has just started to move in the last couple of weeks. So all asset classes are finally having some kind of action here after years and years. But you can see gold did nothing for so long, but when it moves and when it has its rallies, it goes. So hopefully this one that we're on now, it's pretty incredible where they go. When gold goes, it goes. Whether it be up or down, it goes nicely. Here's a more short-term chart, goes back only about a year, and it's kind of like a little bit of saucer handle formation. You can see the move up to 1280, and this is as of the end of December, but we're at like 1290, 1294 now, I believe. So we'll see where your trade goes over the next 45 minutes, but we'll look for gold to make a move. Volatility, we'll talk really briefly about volatility later on, spend maybe 30 seconds or a minute on it. Gold volatility was near its all-time lows, or 10-year lows, at about 9%. I think it's up around 11-12% now. It's at its 50th percentile. So, all right, couple things, just a quick overview here, fundamentals of the background. Gold, the demand, where does the demand come from? It's basically jewelry, it's about 40%. Industrial demand's about 10%. Investment demand, which includes physical bars, coins, all that thing, and investments in exchange-traded funds like GLD and the IAU, they're about 40%. So the bulk of it is jewelry and investment demand, and central banks are somewhere between 5 and 10%. This is it kind of graphically, real pretty chart there. But you can see why gold hasn't done too much for a lot of the last 10, 20 years. There hasn't been a huge supply and demand change. There's been some minor things here. And we did have that move up to 1900 and stuff like that. But most of the retail demand has been pretty solid. It has some moves up and down, depending on which of these charts you look at here. But until these things have sustained uptrends or sustained downtrends, gold's probably not going to have a gigantic move like it had in the 1970s and 80, and that move up to 1900. Once these things start moving and the supply and demand thing changes, we'll see. A lot of people, we'll talk more about this later, but people were saying cryptocurrencies are put the lid on gold. The cryptocurrencies are the new gold. It's going to replace gold. Well, we'll talk about that. All right, so what really drives the price of gold? There's like 7 or 8 things that drive it. There's probably 20 things that drive it. But one of the number one things is the U.S. dollar. Given the U.S. dollar is still the world's reserve currency, major changes in the value of the dollar portend changes in inflation rates usually. If the dollar were to get smacked, it usually means there's some inflation coming on down the road, a debasing of the dollar. And we've had several dollar crashes over the last 30, 40 years. And as a result, yeah, you can see it from the chart here that gold, when they move inversely, when the dollar goes down, gold goes up in general. When the dollar goes up, gold goes down or sideways. So that's by the way, that really nice chart with the red and the blue on it comes from the Federal Reserve Economic Database. You can get all sorts of great charts on there. I recommend you go to it. They have all the spreads for the treasuries around the yield curve. You can see the flattening of the yield curve, and it's pretty impressive what the government websites come up with. All right, so I came up with my top 10 list here. What drives gold? Again, U.S. dollar as the world's reserve currency. What it does is very, very important in the price of gold. If it should ever be supplanted as the world's reserve currency, obviously that changes the equation, but most people don't see that happening anytime soon. What was it? Dennis Gartman said, we will be the reserve currency as far as the eye can see. Because he says the one that's got the biggest nuclear arsenal usually has the reserves currency, and I find that pretty interesting, but economists might argue with him. Second, CPI, inflation, PPI, CPI, all these things, the price of goods. We had massive inflation in the late 70s, early 80s, and gold showed it. So changes in the 10-year Treasury note and interest rates. Usually when rates go up, it makes it a little bit more costly to own gold, and therefore it won't go up as much. But it's also changes in real interest rates, which is point number 4. When rates go up dramatically, like they did in the late 70s, early 80s, they went up in response to very, very high inflation rates, high CPI, high PPI inflation rates. So it's not only rates, but it's real interest rates, where interest rates adjusted for inflation are going. And that has a major impact on gold, and that major parabolic move we saw, but real interest rates were changing so much. Obviously, investor sentiment's a huge thing. Gold has been kind of lackluster for a long time, so if anybody jumps on board here, you're going to get some nice rallies, which is what we've seen the last couple of weeks. We've had zero interest rate and near zero interest rate policy. When you have rates, if you look at some countries, they still have negative interest rates. So one of the greatest things you can invest in now in Japan, I believe, is safes, because people are getting negative interest rates on a 10-year Japanese government bond. So you basically, or maybe you're getting 1/10 of 1 percentage point. So you're going to lock up your money for 10 years. And 10 years later, you're going to get a couple dollars back. Well, most people would rather just take their money, buy gold, and stick it in a safe. So safes are flying off the shelves in Japan, and zero interest rate policy is pretty good for gold in some countries, all right? You also have central bank purchases. Obviously, they can do some very, very large purchases, and that can affect the price of gold. They've been kind of net sellers of gold over the years, but a decade back, they turned net buyers. So you look for those announcements. China's been a big rumored buyer of gold, so we'll see. The GLD ETF, whenever you do creation and redemption, that's how you make an ETF. You put with stock ETFs, the portfolios get created by buying the portfolio and handing it off to a trustee and custodian, and then it trades in the market. Same thing with the GLD ETF. Creation redemption is based on physical gold. The ETF is based on physical gold holdings, not mining stocks. So if there's a lot of creation going on, you need gold bullion, and that will affect the price of gold. Geopolitics and anxiety, and now to some extent, oil prices also drive the price of gold. Anytime there's a threat of a major war in the Middle East, gold reacts. I've seen it go up, anywhere between $5 and $50 an ounce when we get some severe warnings about things going on over in the Middle East or a big oil-producing country, or whenever there's volatility in the world, and as there is now in some places, with Syria, the pullout with Syria, what's going on with Turkey, with the Kurds. So geopolitics play a big, big part of price of gold and price of oil. And of course, mining supply and demand considerations. If mines are shut down or it becomes really, really unprofitable to run a mine, it'll shut down. And that's when you start to see nice rallies, when they shut down mines and production can't do it. But yeah, someone just mentioned Aramco too. That's going to be a real important thing. They're supposed to go public last year. I don't know if they did or anything like that, but what's going on in the Middle East is always something you need to look at. It could be, it could be wildfire for gold. All right, here's a real quick look. We'll just spend a minute on Bitcoin. People out there, I've had many arguments with people that Bitcoin will take the stock market down. Bitcoin will take, Bitcoin will replace gold. It's like, so we look at this chart. This is updated too. I just updated a couple days ago. And you can see Bitcoin. It's in last place on this. Bill Gates used to be able to buy all the Bitcoin in the world, but Bitcoin's fallen so far so fast, he can easily buy all the Bitcoin in the world, assuming the price stayed at around $4,000 per coin. So $70 billion is the market cap of Bitcoin. Bezos, 126 billion. All the cryptocurrencies together, 136 billion. Flip on over now, and you can see towards the other end, gold. The market cap of all the gold in the world is 7.8 trillion. That's about 110 times the market cap of Bitcoin, and it's about 60, 70, 80 times the market cap of all cryptocurrencies. So I don't see Bitcoin taking over gold anytime now. That's not to say that Bitcoin doesn't have a great future. I believe it does. I think the whole blockchain and distributed ledger system has a major impact on the financial world and what's going on in the world, and how it will be used with banks and the financial intermediaries. It's got a big future. The problem is the price of Bitcoin just had probably the largest historic bubble in the history of the world, going from nothing to $20,000 per coin. And we took the air out of that pretty quickly. But to supplant it, let's look at some facts here. All right, Bitcoin's incredibly small. We know that. Market cap of gold is much, much larger than Bitcoin. Cryptocurrencies aren't that different than fiat money. Look at all the ICOs that have come out. There are maybe 50 cryptocurrencies 7, 8, 9 years ago. There's now 2,086. So they're growing like money supply in a way. Gold's a lot more accessible, much more available. It's also a very, very liquid market. Now, that's changing. Cryptocurrencies are becoming very, very accessible. They are getting liquid, but it's still mostly a speculative market. There's no large institutions. There's not a lot of hedge funds in, maybe a few. But until you get gigantic liquidity and participation by institutions, it's never going to be as big as gold. They require a wallet for storage, of course, unless you trade futures contracts. You trade Bitcoin futures at CME Group, which we've been trading for a little over a year now. Good liquidity. You don't need a wallet. You just need a brokerage account. All right, you can set that up easy. Wallets they've been hacked. They've suffered from theft. Some of these thefts have been hundreds of millions of dollars. So security needs to improve dramatically before people trust Bitcoin enough, as opposed to gold, which you can hold, you can store, and you can do it safely. And it's nice and shiny. By the way, I didn't put this in the slide, but I think Visa is accepted at 43 million merchants around the world. MasterCard, about 38 million merchants around the world. Cryptocurrencies like Bitcoin are accepted at about 400,000 places around the world. So it's got a long way to go. Gold, you can go anywhere, any bank, any dealer, and a lot of people will accept gold. So, and like yogurt and bagel shops in the 80s, many of these cryptocurrencies will likely disappear, just like anything that grows like a weed, like it has. Some will prevail, some will do fantastic, and as I said, the underlying distributed ledger and blockchain technology is here to stay. The interesting and most interesting about this thing is regulators and taxing bodies, they have an influence. People say, oh yeah, it's anonymous. You can not have to deal. It's not a fiat currency. You don't have to deal with central banks and regulators. It's like, wrong. The IRS is one entity that always gets its take, and they'll find a way to tax this stuff, and regulatory bodies will find a way to regulate it. That's just the way it is. Otherwise, it will be banned like they try to do in some countries. Cryptocurrencies, they've had about a decade of operating history. Gold's had thousands of years of operating history. So it's been around since ancient times. Anyway, so much of and we talked about this, much of the crypto world has been driven by speculation and a little bit of hype last year. But now we can trade on good fundamentals, if you will. We don't know what the fundamentals are, but when you come down from 20,000 to below 4,000, you've taken a lot of the speculative nature out. We'll see what happens now. Usually when you come off a speculative bubble, you lose 85 to 95% of your value. I think we're at about 80% drop from maybe a little bit less from the top. So let's move on here. Gold supply, a combination of mining supply and scrap metals, believe it or not. We already talked about central banks. It's produced on every continent except Antarctica. And top countries that produce it: China, Australia, Russia, and the United States. Here's the top central bank holders of gold, or top government holders. No secrets there. Switzerland near the top. Very, very small country, but lots of gold. Interesting what neutral countries that failed to participate in World War I, World War II, what they can amass in gold reserves. Pretty amazing. The United States even has that much too, but U.S., Germany, on the IMF, big holders of gold there. But you can kind of see here, also on the chart it shows the gold share of Forex reserves. So, all right, let's get into the futures now a little bit more here. We want to leave time for what's most important. So just gives you a chart average daily volume of all the major metals products, the precious metals, the industrial metals. Platinum and palladium are precious metals, but they're also known as industrial metals because they're used as catalysts or in catalytic converters and other chemical reactions. So gold average daily volume year to date, November 30th of 2018, about 327,000. The open interest 480,000. Later on, we're going to talk a lot more about liquidity. We have some charts up from the new liquidity tool that we have at the Merc that we just put out in September. Fascinating tool. I urge all of you to look at the liquidity tool. For not only metals trading, but any of the trading that you do that the liquidity tool is available for. Copper futures is the second most actively traded futures contract at the Merc. Metals contract, 134,000, open interest double that, 260. Silver, 97,000, platinum, 24,000, and palladium down at the bottom at up 5,800 contracts. Options, average daily volume, gold leads the way by a long shot, 46,000 a day. So for those of you that are inclined, options, it's got a very liquid options market. The open interest, average month-end open interest in gold was 1.4 million. So obviously a lot of people playing the gold options and gold futures market. Copper options, well, they don't look like a lot, but they used to trade only 100 or 200 a day. We just started a market maker program, and things are going well. So silver futures, 7,500 a day, open interest 191,000, and a big drop off for platinum and palladium. They just haven't traded as much. They don't have the cachet, so to speak, of gold, silver, and copper, although they are very important, but they're important primarily in one particular area, and that's auto catalysts. A couple charts here. You can see this is gold. Open interest really hasn't done anything for the last decade. Poking around between 250,000 and 600,000, that gold bar at the top, up and down, up and down, up and down. But volumes generally gone up, especially starting in 2016. We had a major move up, which is really strange because gold hasn't done too much. So we have volume moving up with gold not moving that much. When gold finally moves, we should see these numbers rise dramatically. Same thing with silver, but silver shows both volume and open interest going up too. Gold-silver ratio is interesting. We'll discuss it later when we talk about spreads. Two interesting spreads, three interesting spreads in the metals area here. We'll talk about them later, but it's keeping silver going. People pronounced silver dead long ago because of the drop-off in the use of film. People use digital cameras now, and we have a chart that shows silver fabrication demand, and you can see for photographic purposes, it just drops off the face of the earth. But somehow, some way, silver still trades at a pretty reasonable price, and we'll see why. Platinum and palladium, same thing. Platinum, it's done very well. Yeah, open interest, very nice, strong uptrend. Volume, very nice, strong uptrend. And then palladium down at the bottom there. Open interest generally has gone up, but it's been flat in the last couple of years. Just trending between 20 and 40,000. The volume has been going up over time. Platinum's been, well, we'll talk about the gold platinum spread and platinum versus palladium. Very, very interesting dynamic there when you look at what happened with the Volkswagen scandal, catalytic converters, and things like that. So, okay, on this next chart here, this just shows the average daily volume during our Singapore or Asian hours, okay? And interesting thing there, you can see the percentage of our gold volume that's done in Asian hours, in other words, overnight, is roughly about 30%, 25, 30% of volume. That is incredible. And it's actually getting as high as 40%. So we have the average daily volume in the blue, that's Singapore time, and then we have percent of the global volume as that gold line chart, or that line that goes across the top of the page. And you can see it's between 30 and 40%. The latest data reading that we have there is 40%. So there is a lot of gold being traded around the world. It's not a U.S.-centric type product. If you look at the E-mini S&P, the percentage that's traded overnight, it's a huge number, but the percentage of all the volume is nowhere near 40%. Gold, crude oil are two contracts contracts where there's a lot of volume that comes out of European time zone and Asian time zone. So you'll have good liquidity all around the clock. That's what the point we're trying to make with this chart. If you want to trade after hours, this is perfect. Obviously London's a major center for trading gold. Asia, Singapore, Tokyo, major centers for trading financial stuff and commodities too. Okay, so before we get into spreads and strategies and stuff like that, let's talk about this liquidity tool. We just launched it in September. It's only on our major products. We do not have it on every product. We have it on our bigger contracts, except Eurodollar futures. You don't need a liquidity tool. You want to do a $10 billion notional amount trade in Eurodollar futures, you can do it without moving the market. It would be one tick no matter what size you did, unless you did some astronomical trade that I've never seen done yet. But in options, you can do up to 100,000 contracts and not move the market. It's just incredibly liquid. So they didn't spend all the time doing the data analysis. But what we have here is gold, and this is the liquidity tool. And all I want you to pay attention to is this dashed line here, okay? And you can go to this liquidity tool. It's free. Go to the Merck website on cmegroup.com. It's free. You just register. You just need a user ID and password. Totally free. And you can call up any time zone you want. You could do U.S. time zone, European time zone, Asian time zone. You can do gold. I'm not sure what other metals you can do, but there's a couple dozen products that you can do. And you can measure cost in ticks to buy and sell a number of contracts. In this case, I put in one contract. How much will one lot move the gold market? It will better not move it a lot. This will be embarrassing. A 5 lot. So let's look here. Look at the dashed line. And in October, it was 1.03. So this is for the fourth quarter, 2018. And it shows the bid offer spread on gold. And we can see it's between 1.02 and 1.06. Basically, rounding it off, it's about one tick. And you can see some of these green lines go way, way up to 1.14. Those are days when there's lots of volatility. When we're way above and way below this line, that just shows liquidity breaking down a little bit. But even breaking down a little bit, it goes from 1.03 ticks to 1.12 ticks. It's still basically a one tick market. Well, for a one lot, it better be. So let's go to 5 lot. It goes up to 1.04. The dashed line starts at just below 1.04, goes up to 1.08, almost 1.1. All right. And then, of course, there were some very volatile days in November, December, and it went up to 1.22. Still a one tick market at a 5 lot. Let's get into bigger size, 25 lots and 50 lots. I think that's it. I only did 25 and 50. Yeah. Whoops. All right. So there you go. With a 25 lot, we go between 1.25 and 1.45. Still about a one tick market, but starting to get towards a tick and a half, 2 ticks when you get it to a 25 lot. And a 50 lot, same thing. Difference between bid offer spread is it's nothing. It's about 1.6, 1.7. So you can see there's times again where a 50 lot will take you up above 2 ticks. To be above 2 tick market. Some of the more volatile days, a 50 lot will push the market a little bit. So that's it. That's the liquidity tool, and there's a lot of ways you can measure the depth of the book too. People look at volume and open interest and measure liquidity that way. Those are good measures of liquidity, but the best measure of liquidity is what's the bid and offer spread, how wide is the bid offer spread, and how many contracts can you get done without moving the bid offer spread, and how many contracts are below the best bid and above the best offer. And the liquidity tool does these things. This is just one rendition of what it can do. All right, quick review. Take some water here. These are major contract specs for our precious metals: gold, silver, platinum, and palladium. Gold's 100-ounce contracts. The minimum price fluctuation for GC is the ticker is 0.10, so it's $10. Every tick in gold's $10. Silver is a 5,000-ounce contract. It moves in half a cent, and that's $25 an ounce, or $25 per tick. Platinum moves, it's a 50-ounce contract, so it's half the size of gold. And palladium is 100 ounces, so it's the same size of gold, but it's got a different tick value, 0.05. It's a nickel. Contract months, I'm not going to read all that stuff. You can go on our website and see all the contract months that are listed, the price limits, when they expire, all these things. Everything is available. Settlement prices, high, low, close, all that. We have the Globex trading hours, basically. With the exception of an hour a day, it trades almost 24/7. We're not open on Saturdays, and we open up for trading on Sundays at 5 o'clock. Price limits, there's 4 levels of price limits for gold: 90, 180, 270, 360. We rarely hit these. If we hit 90, that would be a miracle. One day we can hit it. Probably be on the upside would be my guess. If there are some bombs dropped in the Middle East, or Russia attacks the United States, or something crazy like that, you get a big move in gold. But I also list the margins as of December 27th, and you can see 3,400 for gold, 3,600 for silver. Why would platinum be 1,700? Simple. It's a smaller contract. It has basically the same volatility, although lately the volatility has been a little higher as it's been plunging. Palladium, it's a 100-ounce contract, and it's much higher than gold because its volatility has been a little bit higher, and it's been going up a lot. It's gained on platinum a lot, and it's gaining on gold too. So very interesting spreading opportunities there. Also, for traders that don't like the larger contracts, we have some mini contracts. We have a mini gold. You can just go down there. It's a 50-ounce contract. We also have a micro gold. It's a 10-ounce contract. Now, go down to average daily volume. The micro gold does 8,000 contracts a day, almost 8,100 a day. So a 10-ounce contract would be, a $12,000, $13,000 contract. Much more manageable for a smaller speculator that wants to learn the markets and trade them. Your maximum risk would be $12,000, even if gold went to zero, which it's not going to do. Well, I shouldn't say that, but very unlikely gold would ever go to zero. Even the mini gold at half, let's see, it's the 100-ounce contract would be worth about 129,000 now. This would be roughly 65,000. It only does around 400 contracts a day though. So open interest 1,000. The micro, much more volume, about 8,000 a day, and its open interest is 10,000. Look at the margin. The margin on the micro gold, $340. Basically, this is the overnight margin. Someone said, is that daily margin or overnight? That's the overnight margin. Intraday could be less. You never know. Check with Infinity. All right. 1,000-ounce silver also, it does about 400 a day. Open interest 1,253. So it's a 1/5 the size of a silver contract. So again, things for newer traders or traders that are less capitalized could trade in the gold markets. And here's what we were talking about on the Merck website, cmegroup.com. This shows all the expirations, all right, January, February, all the way to December 2019. We have last trade, net change, prior settlement, open, high, low, close, volume. We have the limit, the high limit, the low limit. And this is the date I updated this slide, was January 2nd, all right, of 2019 at 10:52. Next, again, gold settlement prices, just a different way of looking at things. Same thing, open, high, low, close, change, settlement, estimated volume, and open interest. This is the other chart didn't have volume. Well, it had volume, but didn't have open interest. This shows you where the open interest is. Most of it is in the nearby month, February. That's the one that's pretty much the front month contract now. You can see it's got the most volume, it's got the most open interest, and eventually the Januaries will completely roll over and expire and cease to exist probably in a couple days. I don't know the exact date of expiration for the January 19 contract. So there. Okay, so let's look now. Let's get into a trade, so to speak, and see how things look. So I'm going to look at gold and platinum here. We're going to look at some other things too. But for most of the last 10 years, gold and platinum, they've tracked each other well. Actually, for most of the last 20 years. Something's happened recently, though. And gold and platinum traded neck and neck. And then all of a sudden, platinum had a very spirited rally and traded at more than a $1,100 premium to gold. And now it's completely collapsed, where platinum trades at a $300 to $400 discount to gold. So this is not a normal spread. Spreads usually go lock, step, and barrel with each other, maybe with some movement, just enough movement to make money off the spread. There's correlation, but not high correlation. Well, now it's so speculative. It's so crazy because of what platinum's done. We have to watch out, but it's still worth educating people on and getting them in tune in the market by watching a spread like this. So what's the recognized spread ratio as a spread trader? What might your thinking be? What's the margin offset? Always got to look for margin offset. Sometimes when you trade a spread with both futures contracts here at the CME group, you get what's called a margin offset, or a little discount on your margin. Instead of paying the 2 gross margins on each leg, you only pay a fraction of the amount because the money's here at the Merck. There's a correlation between the spread usually, although platinum and gold's gone crazy. And it's a very, very interesting thing to learn. So here we go. This is barcharts.com. You can do this off the CME simulator. You can also do it off the charts that Jimmy Cagnina showed you too. You can probably do spread charts. This is platinum gold. Let's see, January. And gold is February actually. Platinum is February or January. The other one's February. So you can see there, this is just the spread now. It shows it used to be $1,200. Platinum used to be $1,200 premium to gold. Now it's $424 discount. Actually, that's narrowed in the last couple of days. I made this chart a week or two ago. Platinum's finally back above $800 an ounce. At least last time I looked, it was. And now that spread may be worth looking at. But there's other spreads to look at too. But let's just take a quicker look, a little bit more detailed look. All right, here it is, just the last couple days. Traded between $400 and $360 discount to gold, and then completely fell out of bed and went to almost a $485 discount. So it's had a big move, but I think in the last few days that's changed a little bit. I finally saw platinum over $800 an ounce, but gold also went up too. So that explains how this spread moved even more to a discount. So, as we said, gold and platinum usually track each other, but over the last few years, they don't track each other at all. Platinum's completely fallen out of bed. What has happened? What's to explain this move? Very simple. There was a scandal a few years ago. I'm going to go back to the chart. I don't remember exactly when it was, 2015, I think. 2014. I mean, the spread was already launched on a downward trend. Platinum was underperforming. But then Volkswagen made it a little announcement. They were caught red-handed playing with some of the environmental things and some of the technology on the cars to make it seem like they burn less emissions. And they got in trouble for this. Well, over in Europe, they use a lot of diesel engines, so it kind of like put a damper on sales for diesel-type cars and diesel engines. And platinum is the catalyst used for catalytic converters in diesel engines. Palladium is the catalyst that's used in gasoline engines, used in mostly China and in the United States. So are diesel engines going to disappear? No, but it had a huge fundamental effect and impact, negatively, adverse, whatever you want to call it, on platinum. And it just kept going down and down and down because people thought, you know what? I'm not going to put up with this diesel stuff. We don't know where this scandal's going. We don't know how it's going to affect other diesel manufacturers. And it just put a little bit of a damper. I mean, people are still going to buy diesel cars, but strange. But it completely sent the platinum market into a tailspin over the next few years. So how would you, let's just say now you think it's played out. Platinum being at this $400-500 discount is finally going to go back up to maybe only a $300 discount, or maybe go to parity. Maybe diesel cars will work their way back in, and with things in China not going so well and the United States maybe slowing down, gasoline power vehicles, the demand for them will be a little bit less, therefore a little bit less demand for palladium. And how will it affect the spread if you thought so? If you think platinum's going to outperform, you'd go long 2 platinum contracts. Remember, it's a 50-ounce contract. So you want to get close to dollar neutral if you can, even though this is still not totally dollar neutral. The only way you get margin offset is if you trade it as the clearinghouse recommended margin or recommended ratio. So it's 2-to-1, 2 platinums for every gold futures contract. So you would go long 2 platinums. The margin's $1,700 a piece. You got to do 2 of them, so it's $3,400. The margin on 1 gold contract's $3,400. So the combined margin's $6,800. Now, if there were no margin offsets, you'd have to put up $6,800. We have this spread margin credit of 65%. So you get a 65% discount, which means you'll only have to pay $2,380. That's a bargain to do a spread like this. So you put up very, very little money. It's had a huge move because platinum has had such a big move. This is not a traditional spread. It was at one point, and maybe now it will get back into it or reassert itself as a normal spread. But platinum had such a gigantic move that you might as well have just outright shorted platinum if you were looking for that kind of thing. Remember, all margins subject to change. The next chart's a little bit more interesting in terms of spread trading. It's a little bit more normal spread. And you can see this is the difference now between platinum and palladium. Again, platinum decrease in use because of what's going on with platinum. Palladium increase in usage because of what's going on in China over the last few years. They're driving a lot more cars. We're selling more cars in the United States. We have an economy with historically low unemployment or 40-year low unemployment, and people are buying cars and things are going good, but palladium is the catalytic converted metal used in catalytic converters for gas cars. So you can see there way back in 2015, Platinum is $400 above palladium. And then look what happens over the next 4 or 5 years, or 3 or 4 years. That spread narrows. It narrows, and then when you get to around 2017, palladium goes to a premium to platinum, where it stands to this day. I think palladium is around 1150, 1200. Platinum is about a little over $800. I don't have an up-to-date price right in front of me now, but now, so gold is higher than platinum. Palladium is higher than platinum. But palladium and platinum trade much, much closer to each other than gold versus whatever. But that's all changed since platinum has come down so far so fast. These are, again, spreads you might want to look at. And as you know, if you've watched the other seminars that we've done, I like to talk about spreads. I think it gives people a better handle on the markets. When you can watch two markets, you can watch the relationship between two metals, or small cap stocks and large cap stocks, or a 10-year treasury note versus 2-year treasury note. Gives you a little bit more of a finger on the pulse of the market. And a lot of the great traders I know that make money year in and year out, 10 years, 15, 20 years, they trade spreads. It's definitely in their toolkit. It's definitely in their arsenal. And it's a little bit easier to get your arms around a spread. They tend to take the risk down a little bit. They also take the reward down. You won't hit a home run with a spread usually, unless you did the platinum gold spread in reverse. Then you would have hit a home run because it would have been like being short platinum. But anyways, just look at China versus European preference. Look at the diesel versus traditional petroleum type vehicles being sold, production and supply and demand considerations. And it'll be very interesting seeing what happens. All right, let's talk a little bit about silver now. This is a chart that shows silver fabrication across the major uses of silver. So we have photography, jewelry, electronics and batteries, solar panels, and other uses. Other could be anything. I don't know. Could be housing, could be cars, could be anything. But look at photography down in the dark black there. You could see in 1999, 2000, it peaked. And that's when digital cameras started to go away, and or they came. Digital cameras came. They took away from film because you didn't have to go develop and get your pictures a couple days later or whatever. Yeah, now you can go get your pictures instantly. Well, you can get them instantly off your phone too, and that's what people choose to do. And the film industry kind of like withered up and dried up and withered away. And to where it is, it's been cut by more than half now as of 2017. You would think with that, given how huge the demand was for silver, that the price would be a lot lower than it is. It's $15, $16 an ounce. But we've had an uptick in jewelry. We've had an uptick in silverware. We've had an uptick in electronics and batteries for sure. I mean, just look since 1980s and 1990s to the 2000s. I mean, it's doubled. A lot of iPhones. I remember one day Apple sold 10 million iPhones after the release of the Apple iPhone, what was it, the iPhone 6 or 7? They sold 10 million in one day once. It was incredible. So a lot of silver coming out of electronics, computers, laptops. Solar panels also gaining steam in the last 10, 15 years. They didn't even register on this chart, and now you can see a little bit of gold or yellowish there on solar. And other uses has grown a little bit too. So all the photography demand that was lost was made up for by other things. So silver has held its people. A lot of people were predicting the thing going to go well below $10 an ounce. And it didn't, although the gold-silver ratio reflects strength in gold relative to silver. Whether this will last or not, well, that's subject to opinion, and therefore the possibility of a good trade opportunity here. The highest the gold-silver ratio has ever been, this is gold over silver, or the amount of ounces of silver it takes to buy 1 ounce of gold, however you want to say it. Was as high as 100 back in the 1980s, 1990s. It's about 83, 84 now as we speak. On this chart, it gets up, it touches 3 times, it touches about just above 80, 85. Made it down to a low of below 20, and recent lows in the 2000 era since the turn of the century has been about 35, 40. Here's a newer chart. This goes back to 2017. Nice little steady uptrend. Gold still continues to gain relative to silver. Will this continue? At some point, silver should have a really nice rally because it's this chart's near its top, and if technical analysis works, which it doesn't always work, at some point silver is going to outperform gold. And there is a trade there, obviously. So the silver gold spread, again, just like the platinum palladium, the clearinghouse recognizes a 1-to-1 margin. Strange, but that's the way it is. The margin's 3,600 on a long silver. It would be 3,400 on the short gold. You'll pay $7,000, but you get a spread credit of 70%. So you only have to pay $2,100. So that's something that's pretty impressive. So those that think gold is going to underperform silver, this is your trade. All right. So yeah, it's currently trading 82.50. When I last measured it a couple days ago. So gold's trading 82 times the price of silver. If you think silver is going to outperform, you get long silver, short gold. If you think the opposite's going to happen and this thing's going to head towards 100, you get long gold, short silver. All right, couple quick things. It's 10:40 something. We're gonna run out of time here. All right, we're doing okay on time. So these are just a quick comparison of I wrote a book a long time ago on futures and ETFs. I think they're all fantastic products, but people are always asking me to compare gold futures versus, the GLD. For obvious reasons. There's not really a lot of comparisons. I mean, it's simple to trade the ETFs if you have a stock market account, a brokerage account. But it behooves people to trade the actual futures contracts for a lot of reasons, and that's why we put this chart up here. But both of them rely on physical gold. Gold, you deliver 100 ounces. The Spider Gold Trust is based on bullion. The dollar value of COMEX Gold, one futures contract, is $130,000. So you get a little bang for your buck. It's $121 approximately for the GLD, one share. Minimum tick, $1 versus $10 in the futures. Average daily volume, you can't compare contracts with millions of shares, so we have to put in average daily dollar volume, and here's where it gets really interesting. 41 billion for the CME Group Gold Futures, 0.92 billion for the GLD, and that's just the COMEX Gold, the 100-ounce contract. That doesn't include all the other contracts either. Margin 4% for futures, regulation T margin 50% for ETFs. Margin 4% versus 50%. Transaction cost 0.07 versus 0.8 versus 7 basis points. So there's a big difference there. One's much, much cheaper than the other, and that's because there's a lot more liquidity in it. Management fee, there's no management fee with futures. There is a 4.4%, 40 basis point management fee with the Spider Gold Trust, and a 25 basis point management fee for the iShares. 24-hour trading, only in the futures, unless you're well-wired or have, brokerage accounts in all the time zones. You cannot trade 24 hours in the ETF market. Options, they all have options. The best thing, though, is the tax treatment, which we're always talking about. Futures contracts are treated as Section 1256 contracts, which means they get 60-40 treatment. 60% of your gain is long-term capital gains. 40% of your gain is ordinary income. Turns out to be about the 21% tax bracket, or 21% effective tax rate if you're in the 33% tax bracket. So I think with the tax rate changes last year, I don't even know if there is a 33% tax bracket. I know the top one's 36 or 39, but you don't get this favorable tax treatment with the ETFs. You'll pay your entire gain on a short-term gain. Let's say you made 10 grand in one day or 1 hour. You would pay your full top tax bracket, or whatever your tax bracket is, with the ETF, and you get a lot more favorable treatment with the futures. Silver, same thing. Average daily dollar volume 7.7 billion to 0.2 billion. Again, you don't have the tax treatment, you don't have the 24-hour trading, so it's much well worthwhile to consider the futures over the ETF. And this shows you all ETFs versus all futures. And it's people always say ETFs, oh, they're wonderful instruments, and they are. But the real money flows into the futures contracts by several factors. It's not even close in some things. We're going to skip this now and just talk real quickly about options. But you can see gold. In 2016, 2017, volatility went from 20-25% area to single digits. This is pretty low volatility. It's almost like the U.S. stock market. We were in single-digit volatility most of 2017 and the early part of 2018, and then all heck broke loose and things went nuts. And then oil moved, natural gas moved. It spiked from 20% to 140% implied volatility. The only thing that didn't do anything was gold. until recently. It's finally moved back into double digits. It's probably around 12.5% now. So it's finally moving, and let's see if it finally moves back up to 15, 20%. My guess is it would be accompanied by an uprise in the market as it is now. And you can see we're around 12% volatility. We're back above the 50th percentile. From all of 2017, we were in the 10th percentile or below. And that's pretty amazing. So gold, anything above 11% is in the upper percentile rankings. It's got a long way to go, though, before it hits 26.39%, which is its high of the last 3 years. You can see the effect on the straddle there, and I'm not going to talk a lot about this, but you can see the effect, a dollar amount. If you were to sell short options in a very low volatility environment, that's a mistake. You want to be buying options in low volatility environments. Okay, so, and here's, let me just go back here for a second. This just shows the options growth too. Very, very good growth in volume and open interest in both gold and silver. Silver's been kind of steady though, not too much, and probably a function of it trading between $13 and $18 an ounce for the longest time. All right, we're going to just talk a tiny bit about copper here. I'm not going to go over all these bullet points. I'm only going to make some general comments about copper. Copper is more of an industrial metal. You've heard the term, I'm sure you have, Dr. Copper. Doctor being a health reference, and they use it as a reference toward the health of the global economy. Copper is used in a lot of things. It's used in automobiles. It's used in housing. It's used in pipes. Obviously, it's used in electric wiring. It's a lot. And the interesting thing is copper, 42% of global consumption comes from China. So you need to watch China, because it kind of tells you what's going on. If copper's not doing well, the global economy is not doing well. If China's not doing well, it's pretty much going to affect the rest of the world, although not as much as if the United States wasn't doing well. But China accounts for 42% of it. Most of the production's concentrated at 45% of copper output coming from Chile and Peru and Australia. And Freeport, McMoran Copper and Gold, Rio Tinto and BHP Billiton are the 3 largest producers of copper in the world. They're all publicly traded. China, the U.S., and Germany account for most of the copper consumption. So remember, if our economies, China and the United States, start to head down, copper is going to suffer. If you think our economies are going to recover, copper is going to, do well. So it's a really good indicator. And if you look at copper over the last 6 months to a year, copper has been going down from about 320 down around 250, 260. And it's funny. It went down starting about 6 months ago. The stock market took a while to catch up. The Chinese market was already launched in a downtrend. We have the transport sector in the United States heading down. If you look at FedEx and UPS, down. The retail sector heading down. So that's why there's evidence seems to keep mounting that the economy is going to slow down. Maybe not go into a recession, but at least slow down. And no, someone asked the question, is it true copper leads the metals markets? No, not always, but it's a really good overall economic indicator. Platinum and palladium are not going to tell you that much, except for demand for auto catalysts. Copper is going to give you more of a general supply and demand picture on world economies, especially China's economy, because if you look, there's a chart later on. Let's see, I can call it up. Let's see if I can find it here. Yep. All right, so there's a price of copper. There's a chart. Volume's gone straight up. Copper's been doing very, very well. Here we go. China's GDP, all right, versus copper. Now notice, there's the dark gray line, copper going up, China GDP going up. China GDP suffers in the financial crisis, copper suffers. China recovers, copper recovers. China slowly is decelerating in growth over the last few years, and copper goes down. When you got a country that's responsible for 42%, that's amazing. Anyway, so that's it. We're done with about the hour here, and let's see. I'll answer a couple of questions here. Let's see if we can. Someone said, can we get a copy of the slides? Yes, I always provide them. Jim Cagnina will be able to do that. We'll get you the slides. I always share them. Feel free to use them. Just source the CME group or Dave Lerman. No problem. Let's see. We got any other questions here? Bank of America's recommending overweight for the metal for gold in 2019. All right. Well, that's cool. Let's see. XBT, the whole reason BTC dropped in price, allowing the exchanges and whatever. I don't know about that, but You just had a bubble market. Bitcoin, you just had a speculative fever. I've examined and studied all of the major parabolics in history, from the Dutch tulip bulb scandal to the Mississippi bubble. Bitcoin blew them away. It just was amazing. It happened quickly. It went much more expanded on the upside and fell pretty quickly, just like all parabolics do. So we already entered the margin. When was that huge margin change in gold? I don't remember a huge margin change in gold. It's always been in the $3,000 range, so I'm not so sure what you're asking. Yes, okay, comment here. Big auto companies trying to go electric, which is changing the auto catalyst dynamic. Definitely. We'll see what happens with that. So, Jim around? And that's it. Yes, we'll get you a copy of the slides, and we're about done here, and Jim's going to come back on and see how your trade went. And again, thank you all for listening, and we look forward to good trading in 2019.
David, thank you very much. Appreciate your time. Thanks for walking over in the freezing cold. Oh, he took a taxi. All right, we're good. I was going to have to walk home. All right. Let's see how we're doing. We have 120 sim dollars on the gold trade. Congratulations, everybody who picked short. You were right. 120. We'll let it ride, but take a look at some of the charts right now. This is the chart that I'm showing here. I think there's a couple questions on this earlier. And by the way, this is Jim Kignan. I'm back. This is the Sierra chart package that comes integrated with the Infinity AT trading accounts, and they're pretty good charts. So let's take a look at the gold, and I'll talk more about how to get them and all that stuff if you're interested in doing that a little bit later today. So I'm going to scroll back down here. All right, so a couple things on gold. I'm going to focus on gold. It's one of the more liquid day trading vehicles that we have. Now we're all the way up $60. And you can see here's the trading ladder, right? Bids on the left, offers on the right. We have a one-tick bid-ask spread, which is pretty tight because the bid-ask spread is part of your transaction cost, whether you like it or not, right? So the difference, the closer the bid and the ask spread are together, the better off you are, the more liquid the market. And so this one's pretty good during day trade hours, and it's even okay during off-peak hours. I'll call it. But you can see that the bids and offers 10 ticks deep are a couple dozen or so, double digits all the way through. And this is just limit orders, right? So market orders and stop orders you don't see in the bid column and the ask column. And this is actually a demo account or a simulator. It's real time. This mirrors what you would see with the real account, with an actual account. The sim environment here is very, very good and very accurate. So going back to gold, a couple of observations here. Let me just start with monthly. I have a monthly chart, and what I like to do is look at the trends, right? What's the trend long term, and I'll drill down to what we're doing today. And here's a trend right now. You're not getting a lot of idea off of this particular view. And then we'll go to weekly, and okay, weekly's starting to show a little better picture, where we did have a pretty big bear market that has reversed and is turned into a bull market. And this is from a macro point of view, a longer term point of view. Then we'll take a look at a daily. And remember, my daily is 1,380 minutes, which corresponds to 23-hour trading day, right? So this market's open from 5 p.m. the night before. It goes all night, all morning, all day, and closes at 4 o'clock that day. And there's an hour break between the next session. So really the overnight is only 1 hour long. When you look at overnight margins as an example, it's really only an hour. It's from 4 to 5 Chicago time. And so and this chart now is starting to have some meaning to it. And I wanted to point out a couple of things that I like to look at. I have linear regression up here tracking this bull market that we had in gold. And it was a nicely fit linear regression, simple linear regression. Thank you, Casey. Casey loves our channel. And it gives you points of consideration. And points of consideration are when they cross the median line, and then when they touch the bottom of the channel, or they touch the top of the channel, and it gives you potential trade ideas. Trade ideas, of course, being, hey, we're going to be back in the middle of the channel, more likely than not. And that could be true or false, but that's the thinking of a market that's in a pretty tight bull market trend, which we see here. The second thing that I have is the bottom here. I have a thing called average daily range, and average daily range, it's real simple. It's a 30-day average daily range. I mean, it's not a very complicated mathematical equation. It's not a very complicated indicator. But what you tend to see on these trends, here's one going up, ADR is less than 12. ADR less than 12. When we go sideways, and let's go back a little bit here, and I would say, you know, let's say this is sideways here. I'm put a rectangle there, and we have an ADR that's above 12. 12 is a random number I just came up with, but when you go back in time, it keeps, you know, it's not precisely accurate, but it keeps popping up. And then I'm going to scroll back here even further, and we have a really nice bear market trend, right? This bear market trend for a couple of months here. And again, you'll see the ADR is less than 12. And then we start going sideways, we're above 12. And it's counterintuitive, right? You would think that these trending markets would be a little more volatile and it would have a larger average daily range, but they're actually more orderly than the sideways markets. They're more orderly than the sideways. And that surprised me the first time I saw the observation. Again, there's some sideways stuff here. The second observation that I'd like to make is not only is gold, you know, this is U.S. dollar-based gold, right? You could trade Japanese yen gold if you want. It's a different market, but this is U.S. dollar-based gold. So the price of gold in the value of the U.S. dollar relative to other currencies globally is inversely related, right? So a weak dollar is a strong gold prices. It's not 100% correlated, but it's pretty good. You know, a strong dollar is weak gold prices. And the easiest way to do it is if you don't have a dollar index chart, you know, throw up a Swiss franc chart. You know, here's Swiss franc is strong versus the U.S. dollar, which means the dollar is weaker. And sure enough, gold prices are stronger. So that's kind of just a proxy, a real quick way to see what the trend is in different with respect to the U.S. dollar. If you don't have the dollar index quote on your computer, that's DX. So that's the little trick here. If you're just looking at CME Globex markets, so we have that relationship, but we really do have, believe it or not, this fear thing going on. Fear index thing going on, and I got the Dow plunges 800 points. I think was what happened right here on what's the date? That October 8th, October 10th, and you had a huge rally right when that happened, and it was a paradigm shift of this market. It kind of raised it lifted it into a new sideways channel. So that's always the point of the story is make sure that you know what's going on with not only equity markets, but also with interest rates, which do affect both equity markets and the value of the U.S. dollar, right? So we have an interest rate environment that has changed possibly, at least a paradigm that has changed possibly from hawkish to dovish maybe in January, where we weren't in that situation in October. So that's the other thing to look at. So right now, in my mind, last observation on this chart is we have a top here at 1300, a little above 1300. I have a green line drawn here, and 1300, it's a psychological number. Doesn't mean anything in among itself other than it's a nice even psychological number. We haven't traded that high in a long time, And a lot of folks will be saying stuff like, hey, if we close over 1300, then we're off to the races. We're up to 1350 and then some. And I don't necessarily buy into that from a technical analysis point of view, but from a psychology point of view, I do. So I have that line drawn on there to give me another picture. So going forward here, you have to decide when you're determining your bias. Are we channelizing here? Are we going to start going sideways here? Is the fact that the stock market is, the equity markets maybe not is not going to continue to go haywire as we've seen in the last, I don't know, 2 months. It's been kind of wild, or not. A lot of unusual things going on. And one of the other most unusual things in my mind is look at Treasury bonds. I mean, from November, we had an unexpected, in my opinion, unexpected to me, maybe it wasn't unexpected to you, but a humongous rally. I mean, 12 handles almost. 12 handles. It's $1,000 per tick per handle. It's a $12,000 2-month rally. And now it looks like we're starting to turn around again, which is suggesting to me maybe some normalization and some range-bound gold activity. If not, maybe we're turning the corner. So that's my observation on that particular chart. And let me see what I have on this chart. Yeah. So there we are, looking at the ADR, looking at what happens here at the top of the linear regression channel, and then looking at the other markets to determine bias. When I determine bias, it's if my bias is long-term bullish and it's medium-term bullish and it's short-term bullish, then I'm looking for places to buy. Alternatively, the opposite is if those are bearish. And if they're none of the things, then that changes everything. The last piece of equipment here that I like to use is market profile. This is primarily a futures-based type of analysis. And the idea is every 30-minute period, you're going to assign, this is not volume-based, but every 30-minute period, you're going to assign a letter to a price. Every time a new price is printed within that 30-minute period, you're going to assign a letter to it. So the first period is A, capital A. So from 5 to 5:30 last night, we have a capital A. And then what happens next is the next half-hour period, 5:30 to 6, we're going to assign a B to that particular time frame. And every time a price is uniquely traded in that time frame, we're gonna go ahead and write a B down. And we used to do this manually on the floor of the board of trade with a piece of paper. we would write these things down and then hand it to the broker of the pit, every 30 minutes for an update. But over time, what happens is you build these profiles up there. And the idea is over time, you're going to have a normal distribution, a bell-shaped curve distribution with a point in the middle, a median, which is considered the point of control. And what I've done, though, is I've split these two profiles. And you could easily do this by just right-clicking. I could merge with the prior. I could undo the split. I could and do stuff like that. So what I do is in the small E period, which is 7 a.m. Chicago time, the small A period, I split it, right? So this represents last night. This represents 7 a.m. Chicago time going forward. The other piece of information which you need is the initial balance. This is this blue, I don't know what color that is, aquamarine, I don't know, fluorescent blue. This is a blue initial balance, which this line just shows you, in the way I have it set, is the first 4 periods. So E, F, G, H. This is the range of the first 4 periods. You could change it to just the first 2 periods. You could change it to the first period. You could change it to whatever you want. But I'm basically tracking the first 2 hours of trading, 7 to 7:30, 7:30 to 8, 8 to 8:30, and 8:30 to 9. And after that, this doesn't show up anymore. And what I look for is, if this is consistent with my bias, is oftentimes after you hit that 4th period, if the market either trades below or above the initial balance, that's where all the action is going to happen for the rest of the day. In other words, we're not going to go unless something extraordinary happens, unless something unknown happens, or there's some risk event. We most likely when this we most likely won't trade above here today, 1295.50, but we will most likely trade below here or around here, 1290, which gives me an opportunity to say, hey, you know what? If I'm bearish here, then what I really want to do is look for places to sell, and then look for places, put limit orders closer to the point of control right here at 1291, and be patient. And hopefully we get filled up there. And this is really close to the trade I think we made this morning, although I can't remember where we got in, to be honest with you. 90.04. So we got in right here. So that's maybe a good place to try to get in once we start printing prices below. You got to wait for prices to be printed below the initial balance, and then put your limit order. Be patient. Sometimes you won't get filled, or sometimes you'll be dead wrong. But in my, it's a trade idea. It's something to consider. You have the more observations that you have, and the more times you look at this, the better. Give you a better feel for the whole trade idea in general. But anyway, that's kind of a little trick I like to look at. And this is really a trick for gold. This may not be a trick for every market. Okay. That covers a lot of ground. We're a little bit over the hour time frame, which is fine. Any questions for me or for the brokerage firm or anything else for that matter? Type them in right now. I'll be happy to take them. Last time, this is a good question. Is there a way to get copies of these chart books? Last time I promised chart books, we had the file got messed up, so I couldn't deliver them. But I'm going to go ahead and type in my email address. If you want these chart books, just email me and I'll try to get them to you. I failed last time. I apologize for everybody who was waiting for them, but we had a file corruption problem there. So here, I'm going to go ahead and send this to all. Trade at infinityfutures.com is the email to send me for that. Let's see. Elaine asks, where is the limit order after initial balance is broken? All right, so after initial balance is broken, that's a great question. You need to say to yourself, we are going to shoot back up into this area somewhere. We're going to shoot back up into this area somewhere before we pull back down and in essence start forming the profile down lower. So I always like to look at what the point of control is so far, which is 1291, close to where we got in, and because it's skewed, right? It's skewed toward the bottom. But when you do something like that, you also have to consider where your stop's going to be. And a lot of good places to look at stops are not only when you go from the value area, which is in the gray. Let me delete this so we can see it a little better. The value area, which is in the gray, but the transition between the value area and prices above value. So when I'm looking at this, I'm seeing that the ENF period we traded, up in here, we haven't really traded up there for a long period of time. So if I'm short, I'm definitely wrong once we start crossing that. That's a little aggressive, right? That's kind of high for some folks. The other area to consider is, the transition, right? The event horizon, if you will, to use like a Star Trek word, the event horizon between value area and price. So the idea is, boom, we're going to get back to the point of control temporarily, maybe a little higher than the point of control. Let's do that, and let's actually color code this in green. Green means go. We'll color code this thing maybe to a red, means stop, and then hopefully the profile does continue to fill out down here, which will give you ample opportunity to actually decide where you're happy in getting out, if you're lucky enough to get out. and then you could kind of expand backward and kind of look at areas. Uh, you could look at other days. What am I doing? Uh, Levels. So let's go all the way back 1291, and that just happened to be the high uh, on January 7th. And let's just pick this up a little bit. And you can see here we did peak up here a little bit, but then sure enough, most of our work was down below. I hope I answered that, Elaine, properly. Alfred asks, how does it look on an ATR chart? When you do, so market profile is its own thing. You can't, it's hard to overlay standard in. You could, but it's hard, it gets messy when you start overlaying indicators on a TPO chart. Don't recommend it. Tom, Tom's got a good question. Is there any specific times of day to pay more attention to gold for trading? There's a couple of times that I like to start at 7 a.m. That's why I have this E period bifurcated off from everything else. Because a lot of times between 7 and 8, you'll see some anticipation going on in gold that based on, the anticipation that's going on in the rest of the market. What's going on with currencies, what's going on with bonds, what's going on with equity markets. So there's a lot of activity there, but it's harder to kind of decide if it's real or not. So you can see the average daily range here, or the range, I shouldn't say average daily range, but the range is pretty big for the first 2 hours, 7 to 9 o'clock. We got down to 90, we were up to, over 95, over a $500 range. That's pretty big. Right. So it's kind of, there's a lot of opportunities in there. And if you're that kind of trader, it's definitely a good time to get in there. The other times, I think you got to look at, an hour after the equity markets open. And I think you have to look at the first hour of European trading, which is, I can't remember, it's 2 o'clock Chicago time in the morning. Because stuff there's opinions definitely are expressed by the rest of the world at that time, and it's evident in the futures market. So those are a couple other times you want to look at it. Chris asks, there's a couple of Chris's here. Is gold GC open at 7:20 a.m. CST? And I'm going to say no, it opens at 5 p.m. the night before. And it goes all night, all day. And I know what you're trying to say is, is there a relevant pit time that's kind of transcended into the electronic time for gold trading, and I would say it's that line is foggy. I would look at everything kind of opens up pre-market, in my opinion, between 7 a.m. Chicago time and 8:30 Chicago time when the equity market opens up, and then I would call after that the open. So be careful not to characterize a 7:20 start as more important than maybe it is. Tom, thank you. That's very nice of you. AB, where do you go for market profile education? There's probably some YouTube. AB, send me an email, and I'll send you back a couple of YouTube videos we have on our YouTube website that kind of gives you a 101 on market profile. Eric asks, what's the timeline for the light blue line? Okay, so this light blue line, I think you mean this one here, right? The initial balance. Let me show you how I have it set up. Remember, market profile is TPO on Sierra. Let's open it up and see the settings here. And I have the letter block price set for 5 for gold. So every 5 ticks, if the market trades anywhere within that 5 ticks, it's going to put the letter down. That's how we do that. And then the initial balance, where's that at? Initial balance range, I have it set for 4. So that's 2 hours. And the initial balance is a personal preference, right? It's not you could experiment with it. You could change it to 2, change it to 1, you could change it to 3. And, you'll notice different behaviors between different markets altogether. For gold, I like to put it at 4. even though there's a big range that usually trades during those 2 hours, we don't need to take the entire range out, and we won't. We'll fail at it. Nobody could, sell the high and buy the low. Maybe luckily a couple times, but that's not how you can be successful here. Yeah, Judy, that's a good point. Gold has a London session and a New York session of the sorts. Right. So those are periods when you want to be paying attention, because those are when influencers and decision makers and institutions and commercials come in and do stuff that reflects an opinion. It's not just the U.S. Brad, you are welcome. Thank you for coming. All right, so we covered a lot of ground. Everybody knows how to contact me. One thing I want to, for those of you who haven't tried the platform, we haven't tried the charts, you could do it for free. And you're just going to click on this green button here. You're going to fill the form out, and you're immediately going to get an email with a username and password and the download link, and you'll be able to download. And this is real time, 30 days. The behavior of the charts and the trading ladder are identical to if it was a live account. Keep in mind, demo accounts and simulated accounts have a light blue background. And this is kind of a tip, by the way. If you see a trading educator saying they're trading live money and they have a black, sometimes they do this. They try to hide the word demo. It's light blue is simulated, not real. Gray, if it's a gray background in this area here where I'm moving my mouse, that's real. That's real money trading. All right, but in any event, you'll get to do a couple of things with a practice account. You're going to get to get familiar with a level 2 trading ladder. You're going to get familiar with order entry techniques, not only simple order entry techniques, but also OCO order techniques with the trading ladder. You're going to get intimately familiar with the charting system, and you'll be going to be able to do some analysis in real time for free and try to see if this is for you, and develop your strategies, techniques, and then practice your trades on the trading ladder. So I'm a big advocate of it. If you decide to do this and you decide not to open a trading account with us or anyone else for that matter, that's okay. But the first step is this: getting familiar with the software, getting it on your computer, and dealing with our customer service reps who will help you do anything you need to do. They really will step up to the plate to help. Judy, there's no trading contest scheduled for any time in the near future. Tech guys are working on other things that are going to astound and impress everybody, and that's where the focus is right now. But we will do them again at some point. Chris, thank you very much. Casey, thank you. Saying that, best in the world. I appreciate that. Yeah, they're fun for sure. Sam asks, can you open an account if you're based in the UK? UK citizens, absolutely. We have a lot of UK citizens here that trade with us. Barry, thank you. We actually folks from all over the country that trade with Infinity. Just to show you one more thing here, if you are considering opening an account, there is a open an account button up here in the upper right, and you're simply going to click here to proceed. Infinity AT trading platform. Okay, and the FCM is Transact. Then you pick individual, joint, LLC, corporate, IRA, partnership, trust account, whatever you got organized. Most folks are individual accounts, but all these other types of accounts are common also. Michael, thank you. So my email address, guys, again, I'm going to type it in here. It's easy, and I actually get this one. Trade, TRADE, at infinityfutures.com. I'm going to send this to all. Trade at infinityfutures.com. Judy, thank you. Sharon, thanks. Feel free to reach out to me for anything. Question anything. I don't care what it is. I have a German wire hair pointer. You could ask about the dog. Thanks, Ricardo. I appreciate that. All right. So that's it. Hopefully we'll see you again next Thursday. Oh, one last thing. Our webinar schedule is going to be every Thursday from going forward. One a week on Thursday. Next week, we're going to, the topic I think is trading around FOMC craziness. I mean, that's not the real title, but that's, that's the idea. Trading around FOMC decisions. So that'll be next week, and you guys will see it on the website shortly. Anyway, thanks again, guys. Really appreciate it. Had a lot of fun. Thank you, David Lerman, CME Group. As usual, you are awesome, and hopefully I can get you back here to do some more stuff with us. Take care, everybody.